Well, good morning, everybody. I was joking on the way over. I feel like it's like when the United app gives you the upgrade when we moved over to the Waldorf. Like, this is impressive stuff. But thanks for spending time. I think we've got a really exciting panel. There's a lot of panels and time devoted to private capital, but I think this particular one focused on the evolution of this particular business. And these great panelists are going to talk a little bit through how today's modern private equity businesses is very different. The playbook is very different than I think the traditional one that we all grew up with and know well. When CAIA started 22 years ago, just to put kind of things into perspective, some numbers, all of alternatives, so this is hedge funds and all of private capital, was less than 5 trillion. And that number on our numbers is about 22 trillion now, and just private equity is 9 trillion of that, about 40%. And that's up 50% just since COVID started in 2020. So we've seen just a tsunami of capital and interest move towards private equity. But as I alluded to, and the subject of today's discussion is a much more important transformation, which, as I said, is the playbook. Going from the typical lever up the balance sheet, urgency to exit, to much more enterprise transformation, rolling up your sleeves and improving the operational business. So that's what we're going to kind of unpack today. You have the bios, so I'm not going to take much time to introduce these distinguished colleagues, but let's jump in. So Collin, maybe I can ask you to comment on that introduction I just started with, which is, again, this move and an arrival from the past version of private equity, which is a lot of energy moving towards the IPO, right? Yeah. Put a lot of debt on the balance sheet and kind of hope for a big exit. That is very different now. So talk us through how we got here. What have been the kind of the trail markers of this move towards today's business?
Yeah, well, thanks all of you for joining us, and thanks for those who arranged the panel. This business is not supposed to be easy. You're almost by definition, if you do what we do, you're buying control of the ultimate illiquid asset. And if that business gets into trouble, there's basically no liquidity. So our mandate is to avoid that adverse selection, buy businesses, often paying a control premium, and drive value for our investors. Over the last decade, and particularly in that late 20, but especially 21 and early 22, it looked very easy with rates going to zero and multiples going up, and many businesses catching this bolus of growth that seemed secular but was actually cyclical. And so now, and there was a tremendous amount of activity then, as we all know. Now we're all left with the backside of that, which is how are you going to create value? And I think that's exposing whether you have a strategy or whether you're just a levered owner for a business. In our case, we have the benefit of 45 years of history almost. And our approach is that you can't really create value on the buy. You certainly can't do it consistently. And anybody who says they do all proprietary deals, I'd be very skeptical of. You want to try to pay a fair price, and then you want to drive value creation. For us, that is often changing management to better lead businesses, changing governance approach, investing in growth in different ways, or a lot of times companies are investing too many things and they're not focused. And just making better businesses. And I think the limited partners are increasingly focused on what is your value add, how did you demonstrate that, and what are your disciplines that keep you on that track. I think that's good for the industry. Certainly, a lot of folks on this panel have a similar approach in having a value-added strategy, but we're all differentiated, and I think that's important to find your particular approach that's appropriate for the right kind of deal for your institution.
Fantastic. And I think, the other big tailwind over this same period is a theme, a sub-theme that we all know very, very well, which is companies staying private longer. Martine, maybe you can help us think through what effect that has had, not just in obviously expanding and multiplying the opportunity set, but when you think about the philosophy and the mindset of the private markets basically being seen as satisfying all of what the public markets used to, that whole urgency of moving to the halo of public listing, forgive me. that we all grew up with has been really substituted, and the private markets are doing most of, especially in the new economy. How has that changed this value transformation business?
Listen, I think private equity has grown because in private equity, ownership and control and impact of companies is more effective than in public equities. There is an owner mentality, there's a long-term orientation, there is a focus on value creation that somehow gets diluted when companies don't have a controlling shareholder and managing for quarterly earnings calls. And you see value creation happening more efficiently while companies are afforded the luxury of thinking long-term, and where you have in the cap structure someone who thinks like an owner and is also focused on the long term. So I think this is a trend which is likely to continue for as long as we do our job and continue to focus on the long term. We right now, however, live in a very unique moment. The IPO window has been shut for 2.5 years. This is the longest period it's been shut down this century. Post-correction and greed being substituted by fear, and no one wants to take risks with IPOs. What that's created is a pent-up demand for companies that are eager to go public. At the same time, you had an explosion in number of GPs. Just in the United States, we have 10,000 GPs in private equity. That is an unsustainable number of companies. They raised a lot of capital. Many of them are coming back for fundraising, and their LPs, with good reason, say, show me the money. I mean, I gave you a lot of money, show me the money back. I don't eat IRR, I eat DPI. So there's also pent-up pressure from GPs who need to crystallize their holdings. So I know all of us are benefiting from this unique moment of time where there's endless opportunity of buying high-quality companies in the private markets at valuations I haven't seen in 15 years. So this is a very unique moment in time for our industry, and our industry has the mission and the purpose to continue to be better shepherds and of these companies' fortunes, to earn the right of LPs to give us more assets for us to continue to create value.
And I want to pick on that shepherding, which I think is a good use of the word. It's that stewardship, which takes longer, right? It's a deeper partnership. It's a more intimate relationship. But I just want to press a little bit, maybe back to you, Martina, and anyone else that wants to comment. The IPO market comment that you just mentioned, some of that is structural, as we just talked about, with Sarbox and other disincentives, you might say, the more advantageous governance model of the private markets that you alluded to. But you seem to suggest that cyclically you think we'll see a pop return a little bit on the IPO markets.
IPOs will come back. However, there's only been 2 periods in modern history where small companies can IPO successfully. And that was in the walk-up to 2000 and the walk-up 2021. To be properly covered, to be liquid, to access the long-only trillion-dollar managers, you need to have north of about 5 billion market cap. So I think the market will come back, but the minimum efficient scale is higher. And that's for the benefit of everyone.
Jacob, maybe we can talk a little bit about the up and to the right last decade that has been, the easy button to some degree, and not to suggest that there is not tremendous talent on the stage and around the audience, but the reality is I think on the numbers I saw, 6,000-7,000 private equity firms around the world. There's been a proliferation of new launches, zero interest rate environment, low inflation, right? The environment has been pretty darn rosy to capture beta and appear to be very skilled. Do you expect, and maybe even do you want, a little bit of rationalization and differentiation to occur over the next few years?
Yeah, John, thanks for that question. And I think you're right that there is a huge swath of private equity investors today whose entire careers have been learning their trade during a period of low and lowering interest rates, and that and low inflation, and that skill set to succeed in that environment is not what I would say is robust. In an environment where you have rising interest rates, higher interest rates, you have wage inflation, you have raw material cost volatility up and down, but accelerating. You have supply chain disruptions coming from some expected but some unexpected places. Your skill set needs to be much more robust. You need to be able to adjust and adapt to those times. And I think that is inevitably going to result in a washout of a number of firms that just don't have the people or the teams that know how to adjust to an environment like this. And I do think that's healthy. I think we're going to see a reduction in the number of private equity firms if we continue to have turbulence in the economy, which I think is a safe bet that things are going to be rough waters for a while. And so I think that's a healthy thing for our industry. I think there's also going to continue to be consolidation. Some of the very big asset managers have gone away from being investors to being asset managers, are going to continue to grow and continue to expand, and that's going to also shrink the number of players. I think that's a good thing.
Jacob, just as a follow-up, and anyone else that wants to comment, what are some of the disciplines when we move to a more balanced, might I even say, more normalized economy that really will help private equity firms, the better ones that produce true sustainable alpha, stand out? What are those skill sets and competencies that we should be looking for?
Sure. I think this panel is filled with people who've built really successful institutions and go about it, doing it differently. At Platinum, we've really focused on operations capability. We have over 300 employees at Platinum. About 100 of those are on the operations side. And we focus on really adding value together with management teams and the investments that we make. Things like span and layers, IT simplification, increasing digitization, focusing on sourcing and lowering cost of materials for businesses, and many, many other things. So deep involvement in the day-to-day execution of the business. Our people report into distribution facilities, manufacturing facilities, headquarters alongside management, and drive change in the businesses. That's the method by which we've done it, and we're big believers that that's even more important. It can work very well when it's summer or spring or fall, but in winter, and I would describe our current environment as winter-like, in winter it's even more valuable. There are more opportunities, more things that we can go do to the businesses that we invest in.
Chris, anything you'd add on kind of as we hopefully emerge from this winter that really is going to help the stronger players stand out? What would you point to as far as those markers of success, sustainable success?
John, first I want to say it's a privilege to be here and to tell you about GIC. We are Singapore's sovereign wealth fund, and we manage Singapore's foreign reserves. A few things that I wanted to share. One, we're a global multi-asset class investment firm, and we think about our differentiation as where we're from. So Singapore being global and local as a firm. We've been investing since 1981 as a global firm across 11 offices, 2,100 people, all with that singular mission. I run our venture growth equity business at the firm, and to comment and add on some of the insights here. First of all, if we go back in history, it's venture and growth equity has always been a power law business. So 1% of companies go public, venture-funded businesses go public. And as you've said, the bar to go public has gone up. If a company needs to support a $5 billion market cap, the company probably needs $300 to $500 million of revenue scale to achieve that. So for us, we decided let's lean into differentiation where we're different. And so we built something we call the Bridge Forum. It's our way to connect entrepreneurs with C-level executives that make buying decisions and to help drive revenues. So as a growth equity investor, we want to drive growth and help those companies achieve that scale to go public.
Yeah. So Bridget, I wanted to save the last question of this first phase of kind of history, how we got to where we are. I feel like you're in Orange County now. So
I know, it does feel like that, doesn't it?
Yeah. But you have a unique and really interesting perch, one LP, 3 GPs, and you have a seat that sees all of this, right? And while those last 20 years I opened with have clearly been an upward trajectory, and explosive amounts of capital raised. Nonetheless, we have been resilient through a few hiccups, to say the least, with GFC being the big one, but COVID and some fundraising cycles that have been challenging, to say the least. What are some of the markers and kind of DNA of this private equity industry that you've seen at EY that allows us to be so resilient and keep innovating?
Thanks, John, from the other end of the earth. We as advisors have a very interesting vantage point, and I was going to open with that remark that you just raised. And thankfully, I'm not old enough to have lived very long through the point when private equity could buy companies cheap and sell them high without being very interventionist. But I have lived through the refinancing phase of PE, and it's an absolute delight now to be in the very much value creation, value-driven phase of private equity. It's been a fascinating place to build a career, and I always refer to the fact that this industry is just so innovative, so resilient. It's absolutely phenomenal how we find ways around problems. I lived through the 2009 financial crisis, and I saw again the way funds adapted. But what are we seeing today? I mean, if you think about our industry, if I look at my clients, and I loved your phrase around building better businesses, because that is the mantra I hear time and time again. And that's why I believe private equity are great custodians of businesses. And often, if you think private equity funds will have been sectorized now for a number of years, and often before that consumer products idea of a carve-out is just a glint in someone's eye 2 years out, the private equity fund's thinking about who's the best management team in the globe for that. What's our value creation scenario? How do we test that in due diligence? And you've got that interventionist theme right through. So to me, in response to your question, John, I think that is a huge advantage. That is the sophistication of private equity. And many of the people on this panel now, you know, if I stay with consumer products, if you've been investing in consumer products companies for the last 10 years, the data you have available, the KPIs you have available, the access to management teams, that to me is a unique advantage for private equity. And one other recent data point for me is, you know, we look at global capital flows, you look at where there's challenges around the globe. I was in Japan 8 weeks ago, and Japan's corporate reforms just changed only months ago. And the way firms have adapted, the way funds are already moving, some of their best talent, ramping up the teams on the ground, that's just another example of the global agility. So phenomenal, this industry, very resilient, John.
Well, I'm old enough to have still the scars from the dot-com bubble, having been practicing actually back then. And this is not a great job interview point, but I was a terrible analyst, and so I have all these scars from Webvan and, you know, Pets.com, and, you know, these. I was the poster child of kind of drinking the Kool-Aid, to say the least. We obviously have, and because they exist mostly in the private markets now, we have these big booms of transformational themes. It was Web 2.0 back then, and it's been crypto, digital assets, and now AI. Do you think, maybe I'll start with you, Bridget, just back to you, but do you think we've learned our lesson? When you think about innovation, have we also gotten smarter and more discerning in understanding how to invest in these transformational technologies, but knowing that there's going to be a whole lot of mess in between now and then?
I think the answer in summary is yes. It doesn't mean some pockets won't get it wrong, because that's life. But, you know, in EY, as you can imagine, we're advising companies across the globe on Gen AI. So we're advising our corporate base, and we're advising private equity. And what I would say is I spent time with our private equity funds over the last 6-9 months. They're just streets ahead. You know, a lot of them, I would come back into the firm and say, these guys have Stanford professors having weekly calls with them on Gen AI because they see the opportunity. And actually, we then set up our Sprint Co on Gen AI in private equity because we needed to move faster. And I see private equity funds looking at Gen AI in 3 different areas. Firstly, the fund level. How do we use this great technology to be more productive and around our back office? Secondly, the deal level. And the most common call we get at the moment is, from a due diligence perspective, is Gen AI going to really disrupt this company we're looking at? Or is there going to be a huge Gen AI upside? And then thirdly, the value creation side of this. How do we drive productivity by using Gen AI? And I had the fortune to host a Gen AI panel in London a couple of weeks ago. And, you know, the household names of private equity on the panel who are just really involved in this at the moment. It's very active. And actually, the mood in the room, the quote in the room was, as soon as one portfolio company is sold at a huge multiple, because they've deployed Gen AI very effectively, the pressure is going to come on the entire industry. So I think Gen AI is one of those areas where, because of the interventionist nature of private equity, we're going to see huge deployment, and we're already seeing it. But I don't know if others on the panel are seeing the same thing.
It's not all upside, right? I mean, there are companies today that cannot be sold given the overhang. And some of those are apparent, and some are less apparent, and it's a disruptive technology. I do believe our industry, it's a governance model, even across venture through private equity and some other areas. It's a governance model that favors immediacy, clear communication, focus, long-term incentives, alignment, obviously. And that means we can affect things more quickly, and AI is the ultimate case. The pace of dynamism in our economy just continues to grow. One of the questions earlier, John, was what should you look for in a GP? The first thing is not standing still, right? Because this world just changes so fast, and the benefit of our organizational structure is we can bring immediacy, but not every private equity firm is bringing that immediacy or seeing the disruptive elements of technologies like AI that in turn influence how other technologies are used. So it's an exciting time. There's some scary elements to it, but you can't ignore it. You have to kind of dive in.
So to your point of bubbles, so when you were analyzing Webvan, I was starting an internet company in Brazil. Equally exciting.
I probably would have bought your company.
You should have bought my company. and I've lived through 6 bubbles and 5 corrections through my life. And I keep being amazed at how we are repeating history time and time, because it's human nature. And I've come to accept that's good for evolution. We had to get overly excited about telecom. That way, the telecom infrastructure was overbuilt, and now we have almost free wireless broadband. We had to get overexcited about AI, and that way there'll be overinvestment, and lots of people are going to lose money, but AI will be a reality. It's part of the innovation cycle. It leads to acceleration, destruction, recreation, consolidation, and progress. Now, it doesn't mean you as a fund should be pro-cyclical. So one of the hardest things in our industry, and it's particularly hard in venture and in growth, where Chris and I exist, is you have to tie yourself to your ship in the beginning of a tech cycle to not fall prey to the songs of the sirens of AI, or whatever the fad is, and be steady. And have the steady hand, and not get drunk when everyone else is drunk, and not get depressed where everyone else is depressed. I love this time of the market. We just lived through a correction. Everyone is depressed. Chris and I are not depressed. It's the best time.
Some good sound bites there, Martin.
To add to that, we do know that our enterprises are struggling with how are they going to adopt AI. And that's why we built the Bridge Forum on AI. So on May 29th, we're hosting an event. We're going to have 85 to 90 C-level executives in our network that represent $1 trillion of revenue and almost 2 million employees. And they're struggling, like, how do I adopt AI and drive productivity in our organization, or I could risk getting disrupted. I mean, I think the knife's edge is opportunity and disruption. It's real. And so we're going to serve as that bridge into the venture ecosystem and connect them with 50, 60 startups that are building businesses in AI.
Okay.
John, I just want to add that Gen AI is a form of disruptive technology hitting businesses. There have been many before it, and there will be others in the future. And I think Collin and Martin made really good points that what you want culturally in your managers are organizations that can learn, adapt, and evolve. And that is about culture. And when I joined Platinum Equity 22 years ago, we had Ops 1.0, and it was all about cost extraction. And we evolved over time. We have now 6 fundamental pillars to our playbook, but it includes things that involve adjusting margin, adjusting revenue trajectory, digital transformation, human talent. And so you just have to keep growing and adapting. And all of us this is moving very fast. All of us are learning about new applications, new abilities of Gen AI. And I think there are going to be a lot more wow moments that come in this area.
I don't know if you agree. You and I have been around a long time. Not since the internet, I have seen a new technology that increases efficiency 30 to 50%.
I agree.
This is huge.
I agree.
And we're seeing it across the portfolio, and we're seeing it in our business. For the last 3 years, we've had a non-voting member of the IC, which is the AI machine. We call her Ada. And she's so good, so good. And we've back-tested her, and she would have beaten all of us. But that's unfair, because we trained her in the past, so she's very good at predicting the past. The true test is 10 years from now, which is about my retirement age. We will see if she's better than all of us and send us into retirement.
I think she would have passed on WebVan.
She would have passed it.
So I want to move. Hopefully, that's some good level setting, and thank you for that. I want to move to unpacking kind of our core mission this hour, which is hearing a little bit more about the ways you're conducting this operational transformation. Again, moving from financialization, levered finance, to operating partner. Maybe we'll start on the LP side, Chris. And you've talked about, or at least alluded to, the Bridge program a couple times. How is what you expect from your GP partners or your direct work, how is that different than maybe it was 5-10 years ago?
Yeah, so our business that I'm privileged to run has an LP business, and we invest directly in companies. So one observation as a fund investor is it is getting more challenging. There are a lot more funds in market. And so there is a need for GPs to differentiate and differentiate to sustain their access advantage. So I think that's a real thing. I think over time the LP community judges GPs on distributions, DPI and IRR, and we could be at this moment where that lack of liquidity in the market is creating a little bit of challenge for some of our partners. We can be a great partner in that. So that's on the LP side. On the direct side, we have to differentiate GIC just like everybody else. And that's why we built the Bridge Forum, and that's why we're at GIC thinking hard about how do we bring our differentiation to bear for our entrepreneurs.
And as we move to the GPs, Mark Andreessen has been very vocal about his inspiration for this kind of full suite of capabilities, this cafeteria approach to partnering with his portfolio companies, was Creative Artists Agency, which kind of blew up the whole talent agency business. And it's a very interesting history that now that playbook is being applied in private capital now. Many of you, whether intentional or not, have adopted a lot of these disciplines. Jacob, you just alluded to a few. Maybe I'll start with you, Martine. You in the prep, you talked about build well, grow well, this idea that you're really, again, rolling up your sleeves. Talk about some of the ways that you work with these management teams and what you expect from them.
Yeah. So we earn our keep when we generate alpha. If we don't, most of the time people, when they do quartile comparisons, they forget that some people are playing the levered beta game. The true measurement is alpha, and a big component of alpha is company building. What we've learned in our 43-year journey is we're already in version 4.0 of the cafeteria. And version 3.0 was senior statesman figures in the boards giving guidance and support. Turns out that's okay. It's much more effective if you have some tools that people roll up their sleeves and actually add value. So we've got 8 competencies that are, we think, custom made for growth equity and are very powerful, and they're all short, high impact, effective interventions. If you're growing 40% per year, you need to upgrade talent. We've got a 10,000 person talent bank, vetted executives that would love to work for GA. Our executives, our management teams tap into that for hiring. If you're a growth company, you want help in growth acceleration. We have a team that just growth acceleration sprints on pricing, sales force effectiveness, onboarding customers, using AI across the organization. And then the third and fourth, and I won't dwell, the third word is around acquisitions. All these industries, there's too many companies that get funded. We need to reimagine industries and consolidate. It's our core business. We can help our companies acquire. And the fourth and most surprising, ESG. What started as a requirement of our LPs saying you have to be good citizens and comply has now become one of our best sellers because our CEOs have found out that if they don't embrace ESG, they can't retain and motivate millennials and Gen Zs. So we're helping them on that.
Yeah. Collin, you mentioned that I think the number was maybe half of your executive teams turn over very quickly. So you've got this roster of leaders that you're inserting and kind of moving around the chessboard. Talk us through how that works.
Yeah, so GTCR has, we've been around since 1980, so we've had a strategy for 4 decades around bringing human capital to make businesses better, and we actually look for businesses that have that outsized opportunity for enhancement. So we're looking for those opportunities. Back in the 90s, it was primarily the CEO, not the team, and our value add was mostly around M&A, and frankly, the CEOs didn't want much more help than that. The world's become so much more dynamic that it is, as Martine was talking, it's a dialogue across everything related to the business. Now, first and foremost, in our businesses, the CEO and the team do need to run the business and run it very effectively. So we're not looking to get involved intensively in that, and if we do, we don't have the right team. We are partnering with teams in the acquisition process, working side by side in industries we know intensively as partners, which is a fundamentally non-hierarchical kind of structure, deliberating, debating, getting to better answers, creating the value creation plan, so that the day the deal closes in those situations, which is half the deals we do, the day the deal closes, the most senior leader in the business changes that day. And that means that we can accelerate the impact of our plans dramatically relative to in cases where you're backing an incumbent team, maybe an incumbent team that had a lot of incentives from the seller to maximize price. They share the good stuff, not the bad stuff. So that's a very effective way that we can hit the ground running really, really hard. It's across everything. I would say a lot of what we're bringing from a governance perspective and day to day is best practice and also know-how. If we have a question about something going on in an adjacent industry, somebody has the answer to that. As opposed to figuring it out ourselves, a lot of times we're trying to get to that advisor or that expert to get to an answer more quickly so we can then make the changes more quickly. It's about immediacy. On the ESG point, a lot of that is really best practice. It's about governance, it's about data, it's about caring about employee engagement. So that's a mindset shift as you work with management teams for them to understand the potential of a more engaged workforce or energy efficiency or governance or investing in systems and risk frameworks that are going to control your downside. So I get very enthusiastic about this because that's what makes better businesses. More predictable, more visibility, better customer value proposition. If you do that, you can grow faster, you have more customer stickiness, and then ultimately you earn a higher multiple on exit when you're delivering all that.
But Collin, let me just challenge you a bit on, you mentioned employee engagement. There's a big part of that leadership tool belt that is intangible. So how do you guard against kind of culture and morale when a new CEO, a new set of executives is coming in day 2?
Yeah, why is it intangible? It's measurable. I mean, we have, one of my favorite board meetings was a CEO walking in with a heat map talking about every area of the organization. And it's not always the exact answer of what's not working, but it helps you zone in, and then you can talk to different cohorts in the organization. We do that internally at GTCR to understand what we're doing right and what we can't. I think we are a fact-based organization, and the more you can find a way of bringing facts, culture, define your culture. People talk about culture, and then often they don't define it, so it becomes this blank slate. If you define your culture, you can measure yourself against that. So I think this whole area is an area for great opportunity across businesses adopting more of that fact-based approach.
Yeah.
John, I would just want to add to that on culture. You know, at Platinum, we've had a long-held belief that we are not investing in inventory, we're not investing in AR, we're not investing in PP&E. We're investing in people. People are what make businesses valuable. Culture really matters. Instilling entrepreneurship, ownership mentality, speed of decision making are really important characteristics in businesses. As you can imagine, as a firm at Platinum Equity with 100 operators, we offer a lot of help. And what we have found is that the most capable, most secure leaders don't fear that help, they embrace it, and they kind of smile and say, hey, I might want more than you want to give. And that relationship and partnership is just a fabulous culture building exercise in delivering fast value change in businesses.
Yeah. Bridget, you've talked you've used the word interventionist to describe kind of the temperament, the posture, the approach. What does that mean to EY and the way you think about this?
In terms of advising private equity, yeah, we've seen a shift in our business because back in the day, people came to us for the traditional services of financial advice, etc. But increasingly, as the industry has become, as you say, more interventionist, we've built teams to align with that. So now we have value creation teams who can go in and support funds like this on the stage, whether it's pricing experts, whether it's management incentive experts, etc. So we've evolved our business to work with this interventionist nature of private equity. And I was really interested in the ESG point you made earlier. I'm increasingly hearing managers say to me, $1 of good ESG EBITDA is going to be worth more on exit than a less good. So as supply chains are transformed, as we're working to do that, increasingly funds are saying, how do we do this in a more ESG positive way? And I suppose, John, it comes back to, because of that interventionist nature of private equity, we can actually drive change, whether it's ESG change, whether it's implementing Gen AI, in a very positive manner, probably faster than non-private equity owned companies because of that interventionist nature of the industry.
Jacob, just before we move on, I want to come back to something that you at Platinum say a lot, which is this idea of picking winners, right? And there's maybe two sides of the coin to this. On the one hand, there are companies that have perhaps low-hanging fruit on the operational improvement side, so they're easy to kind of turn the dial, but maybe they're not shining when you first take a look at them. On the other hand, you've got winners that show a lot of potential. My guess is a lot of the people on this stage are also knocking on their door and you're competing. How do you balance those that already look attractive with the ones you think you can get the most upside in?
It's an interesting and delicate balance, of course. The first order of business in private equity is not overpaying, right? You have to, whether it's fair value or if you're dealing with enough complexity, maybe actually feeling like you're getting a deal on entry. That's important. But I think where you can get better opportunities is where there is complexity. We specialize in corporate divestitures. We have for 29 years. And we love large, complex, global corporate divestitures, businesses maybe that have never been standalone operations before. And you can see a lot of opportunity, but also the competition can winnow quite a bit because that's a very tough skill set to have and have experience with. We acquired a business from Emerson Electric for $4.2 billion. It was their data center power and cooling business. Took it private, changed management, something Collin and others here do, and invested in innovation around energy efficiency, the ESG story there, and also redirected the business to hyperscale and co-location where it had been focused on corporate data centers. Today, we bought it for $4.2 billion. Today, that company's a public company, $31 billion equity market cap. And believe it or not, we actually sold that to a SPAC. We continued to own a big chunk of it. It is the best performing SPAC ever. So we identified a market that we thought was a good market, a business that was under optimized in a complex global corporate divestiture where we had a skill set that others didn't. So that's how you go about it.
Yeah. I keep anchoring us to before and after just because I think it's important to understand kind of this new world that we're operating in, as I've said a number of times. But so on this next question, again, I'll start with Chris, but I'd love to hear the GP perspective too. It takes longer to roll up your sleeves and kind of improve things than just to lever up a balance sheet, shine it up and sell it, right? And I know I'm being terribly unfair in that simplistic approach, but from the GIC perspective in this, do you have different expectations on holding period and distributions? Have you had to adjust your cash flow models, your expectations of exit with your GPs as a result of this?
Great question. I think a couple things. We are uniquely structured to be a long-term partner in the ecosystem, both as LPs, but also as direct investors. So for us, I think what's unique about us is we're a little bit agnostic to duration. We can truly be long-term patient capital. And I think that allows us to be able to compete and win in very complex situations where liquidity is needed. I give you an example. There's an enormous opportunity around secondaries right now. We think GPs need liquidity. We think employees need liquidity. There's other LPs need liquidity, and we thrive in that complexity. So we have a wonderful my colleague Brian runs that incredible business for us. It's booming. So to answer your question, for us at GIC, I think we're a little bit unique because we can be a permanent capital partner, and I think that helps us differentiate ourselves.
Yeah, yeah. How about on the GP side? Have you had to adjust how you think about the timeline of this hard work?
Listen, it takes time to build great companies. Our average hold is about 5 years. The industry is about 4 to 6 years, so it's about average. We have the flexibility to keep longer. We have the flexibility to put things in continuation vehicle, not as perfect as permanent capital, but 15-year capital for the permanent compounders. But there is a certain beauty with this idea of 5-year terms, just like there's some beauty about 4-year terms in government. You get a fresh perspective, a new set of skills, a new energy. There's a lot that needs to be done. What we find is, even though things are taking longer, what you do in the first year is so important. And for us, we like to spend a lot of time in due diligence, not to find skeletons, but to create the plan of what we're going to do for the next 5 years and what's the priority of the first year. And if you hit the first year, 90% of the time, good things happen.
Yeah, I just add here from Platinum's perspective, we're underwriting an operational transformation plan during the diligence process. And the day we close, we're executing that first day. And what we have found is that in the first 2 years, two and a half years, the slope of value creation is very steep. And then if we've done our job well and we have great management, we're continuing to create value, but the slope has decreased. And we like velocity. So we tend to sell businesses. We often sell 2.5, 3.5 years after we've bought them because we've made a tremendous amount of change. There's more to do. The next buyer can create value. But we'd rather go reset with a new business where that slope is very, very steep in the first couple of years. So we've found that although we're very interventionist, very operationally intensive transformation, it's still fast because of the way we diligence and then execute.
Yeah. See, we do some of the same things. We love complex corporate carve-outs, but we hate velocity because it's so hard to find that great situation. That great team, the serendipity of that all. You execute against that. Often during the sign to close period, you can actually make progress, and then you hit it really hard once you close. When it works really well, you have improved the profile of that business, but then you are finding more and more ways to enhance it, often supplementing that with acquisitions. And so, to an extent, we add execution risk along the way. We try to, mimic some of that first couple of years in the platform with add-on M&A, getting into different geographies, adding product set, other ways to enhance the business. For us, it's about, are we compounding? Are we compounding relative to some hurdle rate relative to our fund IRR and what is of value to investors? We obviously understand we need to deliver cash, but across a portfolio, you'll have some early winners. You'll have some ones that take a little bit more time. You'll have some ones that find their legs later, and then we find it gets to a fairly consistent liquidity profile. The other thing I'd say is I don't think anything has changed as in the environment. I think you have to react to the environment from a liquidity perspective. If you weren't selling aggressively from late 20 to early 22, you missed that, and now you may have some longer dated investments that maybe you regret not getting liquidity. But I think the fundamentals work across cycles, and I think the folks that have maintained that kind of discipline will do well, and the ones that didn't obviously won't.
Yeah. Bridget, there's obviously been scrutiny on GPs over the last couple of decades on alignment and sharing in the upside, right? And fee structure is of constant discussion, right? Regulators are scrutinizing this a little bit tighter. Employees now want a piece of this, and places like KKR are starting to share more with the employees. Where do you think we, and it's obviously near and dear to CAIA's heart as a professional body, where do you think we are in our journey as an industry in aligning the stakeholders around all of us winning?
Yeah. And John, as you know, alignment has been a bit of the secret sauce of private equity, whether it's carried interest at the fund level, whether it's management bonuses, management equity. And I think part of the evolution, and you referred to the KKR example and ownership works, I mean, if you can drive that down to every single employee in the organization, and you know, every economy around the world is grappling with productivity in the modern age. If you can really get that alignment of interest where your worker on the shop floor is incentivized to drive private equity, to drive returns, I think that's the magic. And we've seen some good examples, and I'm delighted as an organization to have been associated with that. Not only then are you driving the profit, but also we've got that great societal impact of what we're doing, and I think that's really important for our profession as a whole as well. So I see it, the more we can drive that with the sophisticated tools, and again, it's been mentioned on the panel, we're very good at measuring things, and we're increasingly building offerings around this, because I think sometimes in the past, we've talked about management, the importance of them, that we've talked about the alignment of interest, but I think we need to get more sophisticated, and we're seeing some of that happening in the industry. So I think that's the next phase.
Martine, let's talk about measurement a little bit. Collin mentioned that most of these things are measurable, right? There's even quantitative elements of things like culture. Again, return on capital is the easy one, but that comes at the end, right? So how, along the journey, along the way, how do you look around and ensure through benchmarks and metrics that you guys are headed in the right direction?
Listen, everything can be measured, but there's such a thing as focusing too much on the measurements and tying it to compensation. It's a fine balance. So you should have clarity of strategic direction. You should have clarity of the KPIs that make you track towards the strategic direction. But recognize that, like, one of the things that made me, I think, a wiser investor is having been an entrepreneur for 7 years, being in the trenches and seeing how complicated and how non-linear the path of entrepreneurs is. Sometimes, if you think like an owner, you will make a decision that's value creating, that deviates from the KPI target of that quarter. But if you're thinking like an owner, it is the right trade-off. So I think you have to have this complicated, delicate balance of having strategic direction, KPIs, and an owner mindset that allows managers to deviate slightly from the KPI path if it makes sense for value creation. And our job is to manage that process, which is not trivial.
I talked earlier about the last 10 years and the abnormal lack of interest rates, free cost of money, right, that has made all of us, I think, happy campers for the most part. But Jacob, maybe, how do you think about the health of the books of these companies, the EBITDA kind of pure health, given that obviously they're facing debt service, no matter how much you're helping them and holding their hand through this, that is stressing the P&L. I mean, we can't avoid that. So how do you kind of get a sense for the temperature and the quality of your portfolio companies these days?
Yeah, so I would say across private equities as an asset class, the surface still looks really quite calm. Defaults haven't exploded, but there are a lot of businesses being held in private equity that are at or near negative cash flow. And the pressure point is not the month or the quarter or even the year, it's the maturity. And when the maturity comes and funds have run out of capital to support the business and refinancing is at a lower leverage point, that's where you're gonna see some real damage happening in the industry. So I think there's quite a bit of latent issues that are gonna surface across the industry. And if you don't have a business model that can adapt, one of the interesting things about rising interest rates is that the Fed's intention is to lower inflation. And it seems like they've done a pretty decent job so far. But in the levered ecosystem, rising interest rates is a form of inflation. It is a cost that is going up in your business. And if you don't have a system and a team that can adapt to inflation, you have a problem. And we took a look at operational inflation that was happening across our portfolio together with financial inflation through rising interest rates. And we were able to go across our entire portfolio of 50 plus companies and have conversations with the management team about how to react. One of the principal ways to react was making sure you had a really good pricing strategy and pricing discipline, And we had 3 types of conversations with our management teams. We had management teams who were seeing it in their business and had a plan, pretty short conversation. We had management teams who weren't seeing it, but once they heard from us, kind of understood it, and we together created a plan, medium length conversation. We had the occasional conversation with management teams who weren't seeing it, didn't want to prepare a plan, didn't think they needed to, and that was a very long conversation, and in many cases not still around. So that dynamic, being able to adjust to a form of inflation, which is rising interest rates, is a very important skill set to have. And I think there are a lot of firms, back to this point of many people in the industries whose entire careers have been in more docile environments, just don't have those skills.
Yeah, Collin.
I think the data orientation for us, we're very proud of our KPI process across our companies. So we saw a lot of margin expansion through Q1 of 22 and some growth that proved to be cyclical. We saw all that start to turn right around April of 2022. Slowing growth, margins compressing, and if you look, 21 was a record high for corporate margins since 1929, so you could see it across, if you look at external sources like on the Fed site that the Fed maintains. So we saw growth slowing, we saw margins compressing, and we saw a lot of negative surprises, and negative surprises that were material. Could have been supply chain, could have been, this facility going offline, that facility going offline, some currency, Europe, ultimately, the Ukraine disaster and tragedy impacting some businesses. And then, of course, you saw rates going up. What served us well was, as soon as we saw the margin flipping and the negative surprises, is working through our investment committee and teams to prioritize the portfolio, look at where you are, who's carrying a little more leverage, especially those businesses that had just done some M&A and maybe re-levered. Those were a little tougher. And then you work through the portfolio and you put a spotlight on the ones that maybe have a few more challenges. You get creative. In some cases, you can do some M&A that helps you through it if it's highly accretive. In other cases, it was taking a lot of cost out. We're not playbook investors. Every situation is different. But in a context in which all those things are happening, the rates are up, margins compressing, growth slowing, negative surprises. We can come up with solutions for every company, and then you're winnowing down the number of companies that have challenges. I'd probably describe the environment even more starkly than Jacob. By our analysis and the rating agencies are getting here, most leveraged loans are negative free cash flow today, and many are severely, and many of those that were done, deals done in the 21 era, lots of adjustments, and much of it didn't come through. Obviously, rates are up. There's, a bunch of those businesses are going to have challenges, and the question is, are their lenders going to be flexible forever on moving to PIK or delayed loan, delayed draw loan just to service interest? There's a lot of that's going on below the surface. To Jacob's point, we're clearly in a higher for longer world. There's not a lot of liquidity options, so we think there's a lot of creative approaches. We're more focused on structured equity, helping people work through those challenges, maybe help fund M&A, de-lever, fund M&A, some junior debt structures that can also help folks move, improve capital structure. I think there's going to have to be a lot more creativity for some cohort of the portfolio companies.
Indeed. And by the way, audience, we've got about 6 minutes left, so some questions are starting to come through, and I will integrate those as I can.
John, if I could.
Please.
We do growth, so the parallel for us, like our companies generally don't have debt, but I'd say the parallel pig in the python for us was this period of 21 where there was a period of overvaluation for our companies. So we're monitoring our portfolio every day. And I think the nuance we're seeing is our companies that are operating the best now are aggressively scrutinizing their capital allocation decisions, line by line. And we're seeing our best entrepreneurs setting their companies up to thrive in an environment where they don't necessarily need to raise capital. I think that's the pig in the python. And if you do need to raise capital, that I think is a more difficult environment to navigate. Yeah. I don't know if you're seeing that.
I completely agree. I mean, there was a new set of investors that came in at the peak of the market that believe in growth at any cost. The damage caused by those investors will live on for a long, long time. If so much value destruction, so many companies that lost their way, we're fixing it, and it'll take another 2-3 years, but we're back to rationality, and it's so healthy.
Yeah.
And so much welcome.
Yeah. I want to just briefly talk about fundraising. And Chris, again, maybe start with you. I mean, the last couple of years, it's like the C.S. Lewis quote, always winter, never Christmas, right, lately. And it's felt like that, but there are signs of kind of spring blossoms. How do you, from at least the asset owner perspective, how are you guys looking at 23, 24, soon to be 25 vintages? Do you expect that we'll look back at these vintages with some level of optimism, or are we still in this winter season?
So I would say we are just a disciplined, consistent investor. Focus and discipline is the mantra in the team. We will make great investments when there will be great returns. I'm not, I have the luxury of not being given, quote unquote, a budget I have to invest or hit. If it doesn't achieve the return, we just won't make the investment. And so that's how I'm managing the challenge that you're suggesting, which is how will this vintage be? I think we're seeing real time a bifurcation in the market. I think anything with .ai has a rich valuation, and it's a tale of haves and have-nots. Yeah. And I think the valuation challenge for those that don't have the tailwinds from AI seem fairly reasonable. So I think I'm sure you're seeing something similar, right? So I think it could be depending on how people navigate it, it could be a great vintage or a horrible vintage.
I'm a little more optimistic. I think we're past the darkest moment of the night. I mean, it's been winter, and the growth equity even darker than in buyouts. Rationality has restored. Best pipeline we've seen in a decade. I wish I could be more convincing with our LPs to give us more money, because I think the next 2 years are very good, but I'm also reminded that the next 2 years are very good because LPs don't want to give me more money. So we'll just do what we can with the capital we can.
Yeah. Bridget, how are you seeing with your advisory discussions? Would you agree that LPs are feeling more rosy?
Definitely. And I was just smiling as you were saying that, because that's exactly what we're seeing. Pipelines have improved. Our business is up. People are looking at more things. Will it be a straight line recovery? I think probably not. People are looking at things in a more cautious manner. So I think a more jagged recovery, but we're definitely on the up.
Yeah. I'm curious, Martine, maybe I'll start with you on this one. The other new entrant archetype that we haven't talked about is the traditional scale asset manager that is suddenly building in a private capital business. So Franklin Templeton has built very quietly a $300 billion alternatives business. Wellington has a fantastic private equity capability. BlackRock is turning back into what they started, which is kind of a diversified private and public company. How do you think this will change? Will this continue? Do you expect to see those not starting to creep in and overlapping with your business?
Of course, the market will become more competitive, and it's natural for such players to come into our market. Just like we have no idea how to do passive public market active investing, and we would have to invest to learn, there is a journey that they'll have to learn, but I have no doubt they will. And we have to continue to iterate and innovate to be better than them.
Maybe I'll end with this one. We had a question on talent, which I thought was quite good. Collin and Jacob, you can both take this. But the old profiles, or I should say the traditional profiles of the types you would hire, sourcing, origination, valuation. Clearly in your new model, you've got to focus a lot more on operational improvement, business folks. So how has that changed the kind of profile and composition of your talent and your employees?
Within the organization, yeah. So I would say we've always been focused as a sector agnostic investor. We've always been focused on operations resources that have functional expertise. So take an IT operations person at Platinum, they would typically have had a career inside a corporation running a mid to large sized IT department, have it humming smoothly, and intellectually they're bored. And the opportunity for them to see in a serial basis IT departments that are unoptimized and fix them is the most exciting corporate job they've ever had. They're not private equity people. They're operators coming out of corporate environments. And that model, we've been consistent for 29 years, and have just grown the team from 22 years ago to nearly 100 today.
Wow. Collin, I'll give you the last word.
Yeah, I'd just say it takes a long time to develop great investors. It truly is an apprenticeship business, and it's a very artisanal business as well. So you can only scale that so quickly. You can't be good at everything. We have added functional leaders in our organization to support our management teams in a very collaborative way. They're not looking to manage, but if you look at areas like procurement or technology or security, the threat environment just gets higher and higher, and companies can't keep up. There's so much best practice to deploy. So having a functional leader that can support our portfolio companies, help find the right talent for them, help assess that talent, help ensure that best practice is being applied, that's a game changer in areas like that and others.
Well, that was a tour de force of today's environment. We're going to have to leave it there, but let's give these panelists a round of applause.